We will now look at what's known as the net present value method to determine which investment projects we're going to accept, which ones we're going to reject. What the net present value method focuses on is the cash inflows and the cash outflows of an investment project. But we look at the present value of those cash inflows and the present value of those cash outflows. When we combine the present value of the cash inflows, that's a plus, with the present value of the cash outflows, that's a minus, when we net them all together, we'll see if we have a positive net present value or if we have a negative net present value. Okay? When it comes to the net present value method, there's two simplifying assumptions from an academic standpoint. First, all cash flows, whether inflows or outflows, occur at the end of the period, other than the initial investment. Again, we're going to assume that all cash flows, whether outflows or inflows, except for the initial investment, take place at the end of the period. Also, assumption number two, that all cash flows generated by an investment project are immediately reinvested at a rate of return equal to the discount rate. Again, all cash flows generated are immediately reinvested at a rate of return equal to the discount rate. So if we're saying the discount rate is 4%, we're going to assume that we can reinvest the cash flows at a rate of return of 4%. Okay? So let's go through an actual problem to determine what would be the net present cash flow for this project. The Lester Company has been offered a 5-year contract to provide a components parts for a large manufacturer. So you're the manager. We have this contract to provide component parts for a large manufacturer for a 5-year time period. These are the cash inflows and outflows tied into this project. Okay? First, got to buy special equipment that'll cost $160,000. Working capital, got to pay our employees. That cost is going to be $100,000. At the end of 3 years, the equipment has been relined at a cost of $30,000. Now, at the end of 5 years, we can sell this special equipment and get $5,000 back. That's the salvage value. Okay? So these are all going to be one-time items. But then we have the annual cash revenues and costs. So the annual sales revenue over the 5 years is going to be $750 per year. Our cost of parts sold each year for 5 years is going to be $40,000 per year. Salary, shipping, etc. is going to be $274 a year over this 5-year contract. So here's the question I'm posing to you. Based upon these numbers, should we accept this contract to provide component parts to this large manufacturer? How many say yes? How many say no? How many say, oh no? Well, let's go through the actual calculation to determine whether or not we should accept this project. Okay? Now, we have a discount rate of 11%, meaning that any project we accept needs to provide 11% rate of return on the investment. So based upon this 11% rate of return, that's our criteria, we're asking, should we accept this project? Let's take a look at it. First, we look at our annual cash inflows and our annual cash outflows to determine the annual net cash inflows. So we look at the sales revenue, cost of parts sold, salaries, ship of other operating expenses. We're saying from this project, after expenses, it would give us net cash inflows of $80,000. So in essence, like on the income statement, our net income would be $80,000 per year. That's $8,000 per year over a 5-year period. Therefore, we want to determine what would be the present value of their annual net cash inflows. Now, the equipment is taking place today. Got to buy the equipment now. That's $160,000. We need $100,000 in working capital for this project today. That's another outflow of $100,000. We'll then look at the annual net cash inflows, which is going to be $80,000 per year. We want to determine what would be the present value of those annual net cash inflows. Now, you have in your textbook, they're going to be in Appendix 3B, what's known as the present value tables. This $80,000, which is an amount going to receive each year for 5 years, is known as an annuity. Again, this $80,000 is what we call an annuity. An annuity is an equal amount to be received or paid over a specified period of time. So using your tables, you want to look up 5 years, that's number of periods, 11%, which is our discount rate, the rate we require on any investment. Look up 5 periods, 11% to give us known as your present value factor. That factor is 3.696. Again, that factor is 3.696. You will multiply this factor times the annual cash flows to get the present value of those annual cash flow. What are we saying? We're saying $80,000 received each year over the next 5 years at a discount rate of 11% is equal to today $295,680. Say it again, I will. We're saying $80,000 received each year for the next 5 years at a discount rate of 11% has a current present value of $295,680. So give it, for example, let's say you won the lottery and they told you can either receive $80,000 each year for the next 5 years, or you could take a lump sum amount today. That lump sum amount, ignoring taxes, at 11% discount rate would equal $295,680. Okay? We got some other items. In 3 years, we have to spend $30,000 to reline our equipment. That's 3 years from now. We're saying what is the present value of that outflow that would take place in 3 years? You have a separate table that gives you the present value of $1, which means the present value of a single sum. See, the $80,000, that was an annuity, an amount received every year for 5 years. But the $30,000, that is a one-time cash outflow to reline the equipment, and that would take place 3 years from now. So now using your present value of $1 table, which means present value of a single sum, your N equals 3 because we'll spend this money 3 years from now at a rate of 11%. That factor is 0.731. Take your factor times 30,000. That gives an outflow of 21,009. So basically what we're saying, 30,000 spent 3 years from now discounted at 11%, has a present value of $21,930. Okay? To clear that up for you, if you took $21,930, put into account today, earn interest 11% annually, at the end of 3 years, you would have in that account $30,000. That makes sense to you? Okay. Then we have the salvage value. We're saying at the end of 5 years, we can sell the equipment and receive $5,000. Now, again, that's 5 years from now. We're saying what is the present value of that $5,000? Use the same table. Present value of a single sum, $1. You look up now, N equals 5, I equals 11. Your factor is 0.593. That amount will be $2,965. The present value of that $5,000 to be received 5 years from now. Also, the working capital, once the project is over, will be released. So we'll get that money back at the end of this project. We'll get back $100,000. But once again, that's going to be 5 years later. Based upon a discount rate of 11%, the $100,000 received 5 years later is worth today $59,300. So now we're going to look at all of our present values of our cash inflows, present value of our cash outflows to get our overall net present value. So we see that this project has an overall net present value of $76,015. Therefore, we should accept this project because it does meet our criteria of 11% return on our investment. It's actually even higher because if it was just 11%, this amount would be zero. Because it's $76,000, we're getting higher than 11% return on our investment. So this is known as the net present value approach to determine whether or not we should accept the actual project. Okay? So at the end of 5 years, the working capital will be released and maybe used elsewhere. So again, we're saying yes, we should accept this project because it does provide us with a positive net present value. So if we have a positive net present value, indicates that it exceeds the discount rate. Now, if it's zero, it's just equal. But if it's a number higher than zero, then it exceeds our discount rate. But if you have a negative net present value, that job is less than your required discount rate. The discount rate represents the rate of return we expect to receive on any of our investments. Okay? Any questions on how to use the net present value method to determine whether we should accept a project or reject it? So again, to summarize it, if it is positive, we're going to accept because it promises a return greater than our required return. If it's zero, we accept because the rate of return will equal our required rate of return. But if it's negative, we're going to not accept because that investment will not meet our required rate of return on our investments. Okay? We're going to take a look. So the discount rate is based upon typically what would it cost us to borrow money. So if we have to borrow money, say if it costs us 5% to borrow money, then that 5% would be our discount rate. Sometimes we might make it a little bit higher just to make sure we're earning an actual profit, but the minimum discount rate will be the rate we're being charged to make an investment. Okay? We're going to come back and look at other ways to determine which capital project we're going to accept. Stay tuned.